This video covers accounting for income taxes. I'll teach you the very important effective tax rate. We'll talk about GAAP accounting rules, which is what we're learning in this class, versus IRS tax rules, and there's differences between those two sets of rules. We break the differences down into permanent and temporary differences. And the ones that are difficult to account for are the temporary differences. So we'll spend some time going through some examples on how to account for these. First, I want to teach you the effective tax rate. So what I have here is Apple's income statement, Apple Computer. So they sell computers and iPhones and all those things. They have sales, cost of sales, and then they have different operating expenses here. Then you get down to the bottom of the income statement, you have their tax-related items, okay? The first item I want to point your attention to is item A, and it's called income before provision for income taxes. And that's just another word for pre-tax income. Okay, how much money did Apple earn before they had to pay income taxes to the government? Okay. Item B is the provision for income taxes. And another word for that is tax expense. What was the cost of taxes that they had to pay to the government? Okay, A and B. The effective tax rate is computed as B over A. So tax expense divided by pre-tax income. How much did the company, what was the cost of taxes to the company divided by how much did they make before having to pay taxes? And so if you compute the effective tax rate for Apple Computer, it's 15.9%. And so the definition of this rate, the effective tax rate, or ETR, is tax expense divided by pre-tax income. And it answers the question, what percentage of income do we have to pay in taxes? Okay, that's the question that it answers for users of the financial statements. Now we'll talk about the two different types of rules for accounting and how they generate differences, okay? So the SEC makes the rules that we talk about in this class, okay, the financial accounting rules. And these rules are designed to make financial statements that are relevant and useful for investors. On the other hand, the IRS makes the rules that determine how much in taxes a company or an individual owes to the government, okay? The IRS has a different objective from the SEC. The SEC wants financial statements to be useful to investors. The IRS wants to be able to collect taxes, but they don't want to obstruct economic growth. So they don't want to take too much money away from companies so that they don't grow and expand their operations, but they do want to fund the government. And so they kind of have a balancing act. And these different objectives give rise to different accounting rules. And we separate these differences between GAAP accounting rules and IRS tax accounting rules into two categories, permanent and temporary. Let me just go through some examples of each of these categories. First, permanent differences. Municipal bond interest. Companies can invest in bond offerings of municipalities. They lend money to municipalities, and the municipality pays interest to the company that lended the money. Well, that interest income, for a company's purposes, they don't have to pay taxes on that income. So even though it might show up on the GAAP income statement as interest income, the company doesn't have to pay taxes on that income. And they never have to pay taxes on that income, okay? So it's a permanent difference. In the other direction, certain travel expenses, so if you send your executives on fancy travel, those aren't fully deductible on a corporate income tax return, okay? You can't take full deductions for those travel expenses. Now on the GAAP income statement, they are full expenses, but on the tax return, they aren't full deductions, okay? And they're never full deductions. And so that's another permanent difference. Similarly, actually going back to the other direction, research and development, the government wants to incentivize companies to do research and development activities, and so they provide a tax credit, a benefit to do R&D activities. And that just reduces the total amount of taxes that R&D companies will have to pay to the government, okay? And that's a permanent reduction. And finally, the final example I'll go over is foreign income. So some companies operate in foreign jurisdictions that have very low tax rates. Well, once they pay that low tax rate in the foreign jurisdiction, they don't have to pay the high tax rate in the US under many circumstances, okay? So that can also cause a company to pay very low amount of income taxes if they're operating in foreign jurisdictions, and that's a permanent difference. They'll never have to pay that back. Now let me tell you two examples of temporary differences. First, a different depreciation rate. So for financial accounting purposes, what we're learning in this class, most companies use straight line depreciation for their GAAP income statement. Well, on typical companies' tax returns, they'll accelerate depreciation expense. So they record a lot of depreciation expense in early years and a little bit in later years. And so that just gives rise to a temporary difference. It's still the same total amount of depreciation expense. It's just recognized in different periods, okay? And the second example is a net operating loss carry forward, where if a company is operating at a loss, so they have negative income, they don't have to pay any taxes, and they can use those losses to offset future taxable income and pay less tax in the future. Okay, so that's a difference. You know, a GAAP income statement, you can show negative GAAP net income. But for tax purposes, there is no such thing as negative taxable income because the government's not going to, pay you money if you lose money. Okay, so those are examples of permanent and temporary differences. And the idea with the accounting for these differences is these permanent differences will affect the effective tax rate. The cost of taxes for companies with these permanent differences will be affected by these items. Temporary differences, this is where the difficulty comes in, is we structure the accounting so as to not allow these temporary differences to affect the ETR that investors are calculating on our income statement. And we'll go through some examples of that. So let me show you a tangible example of what a permanent difference looks like and what a temporary difference looks like. First, a permanent book tax difference. Here in this column, we have taxable income, and in this column, we have income that shows up on the GAAP income statement, or maybe we'll call that pre-tax income, okay, on the GAAP income statement. And you can see that taxable income is just persistently $20 less than GAAP income. And it's like that in year 1, in year 2, in year 3. And in fact, total over 3 years, total taxable income is just permanently less than GAAP income. Okay, this is a permanent difference. On the other hand, a temporary difference, you can see that in year 1 here, taxable income, again, is lower than income that you see on the GAAP income statement. But that difference reverses in years 2 and 3. So in year 2, taxable income is the same as GAAP income, and in year 3, taxable income is higher than GAAP income. So that when you look at the whole time period put together, taxable income is the same as GAAP income over time. There was just a temporary difference in year 1 that reversed in year 3. And this scenario is the scenario that's going to be difficult to account for, and we're going to go through an example of how to account for that. So the rules for accounting for income taxes is just broken down into 3 parts. Step 1, compute taxes payable. Now, taxes payable is the amount that companies owe to the government based on their current period tax return, okay? Taxes payable is going to be a liability account on our balance sheet until we actually satisfy the obligation by paying the government, okay? So how much should we credit this liability account? Well, you take the statutory tax rate, okay, that's determined by the government, and you multiply it by taxable income, which is at the bottom of your tax return. So this is determined by the government, the statutory tax rate, and taxable income is on the tax return. Okay, so our tax department is going to come up with these 2 numbers. They're going to multiply them together, and they're going to determine how much do we have to pay to the government. Now, if for some reason taxable income is negative, you're never going to pay less than zero to the government. Okay, so if taxable income is negative, taxes payable to the government is just going to be 0. Step 2 is that the accounting department, so that's what we're learning in this class, comes up with what should we have as tax expense on our income statement. And tax expense is going to be equal to the effective tax rate. So the accounting department figures out what is our effective tax rate. Okay, that's a calculation process that goes on within the accounting department. Then they'll multiply it by pre-tax income, which is right there on the income statement, to get tax expense on the income statement. Now, to the extent that there's differences between taxes payable and tax expense, those differences will go into either an asset or a liability account, depending on whether the difference is a debit or the difference is a credit. We'll create asset or liability accounts to track these temporary differences, okay? And now we'll go through an example. So here's the example. And right now we're just going to start with a permanent difference only. Okay, that's the only thing we have going on in this example. So it should be pretty simple. And let's just pretend that the difference, what is giving rise to the difference, is municipal bond interest income. So this company is generating $100 of pre-tax income per year, but $20 of that pre-tax income is municipal bond interest income, okay? $20 of that is not taxable, and it's permanently not taxable. It's never taxable. So when you look at $100 of GAAP income in year one, on the tax return, it's only going to show $80 of taxable income, so that you're only taxed on that $80. And that's a persistent difference, okay? $80 in each year. So here's just a permanent difference. And we're just to make things simple, we're going to set the statutory tax rate. So that's set by the government. The government determines that the statutory tax rate is 10%. You need to pay us 10% of your taxable income. Okay, the effective tax rate, remember, is determined by the accounting department. And the accounting department knows that they have $20 of municipal bond interest income. We don't have to pay taxes on that. And that's going to reduce our effective tax rate down to 8%. So the accounting department knows the effective tax rate of 8%. Okay, in year one, what happens? Here's the journal entry. First, remember, we credit taxes payable for the amount we owe to the government. Well, the statutory tax rate's 10%, taxable income is $80, and so we owe $8 to the government. That's taxes payable. Step two is to compute tax expense, and even though it's the same result, we calculate it in a different way. We take the effective tax rate, which our accounting department determined was 8%. We multiply by $100 of GAAP pre-tax income, and we have tax expense of $8. And the good thing about this is investors are able to recover the effective tax rate just using our income statement, okay? They'll take the $8 tax expense divided by the $100 pre-tax income, and they'll know that our effective tax rate is 8%. And this journal entry is actually going to repeat in year two and in year three, okay? Because this is just a persistent difference. Taxes payable is always going to be 10% of the $80, and tax expense is always just going to be 8% of $100. Now, to this picture, what I'm going to add is a little complication. I'm going to add a temporary difference, and that temporary difference is going to give rise to a deferred tax liability. And the reason it's going to give rise to a liability is because in the first year, we're going to need a credit to balance our journal entry, so it's going to create a liability. And what we're adding to this picture is accelerated depreciation on the tax return. So you can see that the total taxable income over 3 years is still $240 versus $300. So that same permanent difference is in there, but now there's a temporary difference layered on top where we have very low taxable income in early years and high taxable income in later years. The reason for this is IRS rules typically allow for accelerated depreciation on the equipment and property that you buy. And this is to incentivize investment. So if you invest in this piece of property, you get to take a huge depreciation deduction in the first year that you own the property. And that causes you to have very low taxable income in year one of owning the property. And what it does is it reduces the net present value of your tax bill because you're paying very low taxes now and higher taxes later. And so the net present value is very low in terms of your tax bill, okay? So I hope you see how we've layered on a permanent and a temporary difference. Now the statutory tax rate is still 10%, and the only thing that affects our ETR, our effective tax rate, is the permanent difference. So actually the permanent difference has stayed the same, and our effective tax rate is still 8%. So let's see how we account for this situation. So here's the first year journal entry. Step one, remember, is determine taxes payable. We'll take the statutory tax rate of 10%, and we'll multiply it by taxable income on our tax return. So 10% times $70, and we have to pay $7 to the U.S. government. So that's a credit to taxes payable. Step two is to come up with our tax expense. Again, this is the same calculation as before. 8% is our effective tax rate. We have $100 of pre-tax income, and so we have $8 of tax expense on our income statement. So you can see that 8 is not equal to 7, and we need to balance this journal entry with a credit. So here's that credit. And because it's a credit to balance the journal entry, I call it a deferred tax liability because liabilities have credit balances. So I'm going to call this a deferred tax liability, and it just keeps track of this temporary difference. In year two, let's see what happens. Year two is kind of the equalized year where taxes payable is still that 10% statutory rate times $80 now of taxable income. So you can see taxable income went from 70 up to 80, and now we're paying $8 to the government. Tax expense is still $8, 8% times 100. And finally, in year 3, how much should we pay to the government? Well, taxes payable is $9 now, 10% of the $90. See how this is up to $90 now? So now we're paying $9 to the government. Tax expense is still the 8% times $100 of $8. And now we need a debit to balance this journal entry. And this debit is just reversing out that deferred tax liability that we created in year 1. So here we created it in year 1, and we're reversing it out in year 3. It went away. And let's just see what we can observe in these journal entries before we move on. Tax expense stayed at $8 every year, okay? That's because we want investors to be able to compute our effective tax rate every year. Each year they'll take that $8 and divide it by 100, and they'll come up with 8% as our effective tax rate. And that's correct. That is the cost of taxes to our business, okay? And here, the taxes payable is increasing over time. It started at 7, went to 8, and went to 9. So you can see that we're paying a very low amount of tax in early years and a very high amount of tax in later years because the IRS is trying to incentivize us to invest in this property. So we get to reduce our tax bill in these early years and reduce the net present value of our total tax bill. Okay, finally what I want to do is show you how all of these transactions are going to show up in the footnotes to the financial statements. So here you know the entire situation for these 3 years for this made-up company. Now I want to show you what their footnotes are going to look like. First, I'll show you their income statement, okay? So this company, this is their GAAP income statement. GAAP, sorry, that's a P. So their GAAP income statement has all different types of expenses on it. It's also got municipal bond interest income there of $20. And you get down to pre-tax income or income before tax expense of $100. Remember, that's that column here. That's the column, $100 each year, 2017, 2018, and 2019. Here we have our $8 of tax expense in each year, so we can calculate that 8% ETR in each year, okay? And we'll come down to net income of $92 each year. Okay, that's what our income statement will look like. Now let's go down below the financial statements. We'll go to the tax footnote. And the first thing we'll see is the components of income tax expense. So total income tax expense here is $8 in 2017, 2018, and 2019. What are the components of that expense? Well, that expense has a current component and a deferred component. Current means what did you pay to the government? Deferred component is just what entries did you have to make to fix for those temporary differences, okay? So these are the amounts that go into the DTL or a deferred tax asset, either a deferred tax liability or a deferred tax asset, okay? That's what the deferred components are referring to. That's the first component of the tax footnote. The next component of the tax footnote is a reconciliation between what you would have had as income tax expense if it was just the statutory tax rate versus what you did have as income tax expense based on all of your permanent differences, okay? So this table just shows you a listing of a company's permanent differences. So what causes one company to have a permanently low or high tax rate versus another company to have a different tax rate, okay? This helps investors determine why the cost of taxes for one company is different from another company. And so for this company, the only permanent difference we have is this municipal bond interest income. So if this company were to pay just 10% of its pre-tax GAAP income, they would pay $10 a year, and that would be their income tax expense. But they gain $2 a year because they don't have to pay taxes on that municipal bond interest income. And so the amount of tax expense that they actually show on their income statement is $8 per year. So that's what this reconciliation table is meant to show you, is a listing of the permanent differences and what effect they have on income tax expense that you see on the income statement. So this here, just as a final point, this here, you'll be able to tie it out directly to the income statement. Okay, the next part of the footnote is just a listing of all of the deferred tax assets and liabilities that the company has at year end, okay? So this will actually tie to the balance sheet. And this company didn't have any deferred tax assets, okay? We created a deferred tax liability for this accelerated depreciation of PP&E. When we paid a very low amount to the government in year 1, well, we knew that in year 3 we were going to have to pay a very high amount to the government. So we set up a liability, and the liability reflects our obligation to pay off that larger amount in year 3 of owning this asset. So we credited the liability account, establishing it in 2017. It still existed in 2018. Remember, that was the year when tax expense was equal to taxes payable, so there was no effect on the DTL. And so the balance was still there at the end of 2018, but the balance reversed itself out in 2019 and went down to 0 because, remember, in 2019 we paid $9 in income taxes. So we made up for the, we paid $1 less in 2017 and we paid $1 more in 2019. So we actually settled that obligation with the government. And so what this table does is it just tracks the year-end balances of your deferred tax assets and liabilities at the end of each year. And so you'll be able to tie these total numbers out to the balance sheet. Okay, that was a long one, but let's just recap what we talked about. We talked about the SEC and the IRS have different rules for computing income. We talked about permanent differences which affect the ETR. They cause companies to either pay higher or lower taxes permanently. But we also talked about these temporary differences and how we shield the ETR from temporary differences. And we do that using deferred tax assets or deferred tax liabilities. And we went through an example of a deferred tax liability.